There's a number you've probably never watched in your life. And last week, it quietly reset the price of your mortgage, your car loan, and your 401(k). It's called the 30-year Treasury yield. And it just hit 5.18%, its highest level in about 20 years. Now, if your eyes just glazed over at the words Treasury yield, stay with me. Because this is the single most important number in finance that nobody explains to normal people. And by the end of this, you'll read it better than most of the people on TV. I'll show you what it actually is. The three forces that just sent it to a 20-year high, and exactly what it means for your money, without the doom. Quick note, this is general information, not personal investment advice.
Let's start from zero, when the US government spends more than it takes in, which is basically always, it borrows the difference by selling bonds. A 30-year Treasury is just a loan you make to the government for 30 years, and the yield is the interest rate they pay you to take that deal. So when you hear the 30-year yield is rising, translate it like this. Investors are demanding a higher interest rate to lend to the United States. And here's the twist most people get backwards. When that yield goes up, the price of the bonds goes down. Yields up, prices down, always. So a spike to a 20-year high doesn't mean bonds are booming. It means people are selling them. Hard. The question is why, and why it lands on you.
Because this number is the invisible price tag on almost everything you borrow. The 30-year has a close cousin, the 10-year Treasury yield, and that one is the benchmark that mortgage rates, car loans, and business loans are built on. When these long-term yields jumped, the 10-year shot up to around 4.7%. Its highest in over a year, which is exactly why mortgage rates have stayed painfully high even while everyone keeps waiting for them to fall. So burn this into your memory. The Treasury market sets the price of borrowing for the entire economy. Wall Street isn't watching these yields because they're nerds. They're watching because this is the number that prices your life.
And notice who's not in this story. The Federal Reserve. A lot of people assume the Fed controls all of this. It doesn't. The Fed sets one thing, a short-term overnight rate. But these long-term yields are set by the open market. Millions of investors deciding what it's worth to lend to the US for the next decade or 3. So when the 30-year hits a 20-year high while the Fed sits still, that's not the Fed's move. That's the market overriding the Fed, sending a message the Fed can't mute. So what's the message? It comes down to 3 culprits.
Culprit number 1, inflation refuses to die. A bond is basically a bet on the future value of money, and inflation is its kryptonite. Getting paid back in dollars worth less is a bad deal. This spring, inflation came in hotter than expected. Consumer prices up nearly 4% from a year earlier, driven a lot by energy. And that energy spike ties to conflict in the Middle East, pushing oil and gas up. When investors smell stickier inflation, they demand a higher yield to lend long, instantly. That's culprit 1, and it's the loudest.
Culprit number 2 is the quieter, scarier one, the deficit. The government funds itself by selling bonds. But the more it borrows, and it's borrowing a lot, the more bonds flood the market. Basic supply and demand. Flood the market with something and its price drops, which for bonds means the yield they must offer to move them goes up. On top of that, investors look at those endless deficits and quietly ask, am I being paid enough to lend to a government this deep in debt? That extra cushion they demand for lending far into the future has a name, the term premium. And after years of being basically asleep, it's back. That's a big reason the long end is selling off, even though the Fed hasn't touched a thing.
Culprit number 3. This isn't just an American story. Investors are dumping long-term government bonds all over the world. The UK's 30-year hit its highest since 1998. Japan's 30-year hit a record. When it's happening everywhere at once, it tells you this isn't one country's problem. It's a global rethink about lending money for the long haul in a world of stickier inflation and bigger deficits. Which is why a survey of big fund managers found most of them expect the US 30-year to climb even higher, towards 6%.
Now, why do the pros get twitchy when the long bond crosses 5%? Because analysts call it a danger zone. Historically, when long-term yields push up here, they tighten financial conditions across the economy. Loans get pricier, and it becomes a real headwind for the stock market, especially the expensive, high-growth names whose value depends on cheap money. But I want to be careful, because doom sells and I'm not selling it. A high bond yield is a warning light, not a crash prediction. It doesn't mean the market falls tomorrow. It means the environment just got harder, and the market is telling you to pay attention.
So let's make it personal. 4 honest takeaways, not advice, just the map.
Borrowers, stop waiting for the Fed to rescue your mortgage. The thing that actually moves your rate is this: the long bond, and it's near a 20-year high. Budget for higher for longer, not for a rescue that keeps not coming.
Savers, here's the silver lining. Yields this high-quality bonds, and CDs are paying more than they have in 20 years. For the first time in a long time, boring, safe cash actually pays you something real.
Investors, higher long yields put pressure on stock valuations and usually mean more volatility. That's not a reason to panic. It's a reason to know what you own and why, instead of finding out the hard way.
Everyone, treat this number as a signal. The bond market is pricing in persistent inflation and serious deficits. So watch inflation, watch oil, and watch the 10-year, because that's the one setting the price of your next mortgage.
So, the 30-year Treasury at a 20-year high isn't background noise for traders. It's the market demanding to be paid more to lend to a country with sticky inflation and endless deficits, and that demand reprices your mortgage, your loans, and your investments. You don't have to trade a single bond to use this. You just have to read the signal, and now you can. If this made the scariest number in finance finally make sense, subscribe. I translate one money headline like this every week, so you always know what it means for your wallet. See you in the next one.